Hello and welcome to this video on the flow to equity method. The flow to equity method is one out of, let's say, 3 or 4 discounted cash flow methods for business valuation. For this video, I planned the following. First, I would like to give an overview over valuation techniques. And then I would like to introduce into the rollback method, which is a part of the present value based methods. Then we have to adopt to the Modigliani-Miller theory as of 1963 in valuation to adjust for the leverage in valuation. And we have to make some assumptions for the valuation that we are going to perform. Then we dig deeper into the flow to equity method. Since we apply rollback techniques, we start with a perpetuity and then we roll back through the detailed planning period. Last but not least, I would like to show how to implement that in Microsoft Excel. This is an overview over valuation methods. We see 4 different types of valuation methods. We start with the asset value methods, then we see the multiples, then we see the present value based methods, and we see the real option methods. The asset value methods are, just like accounting, based on the individual value of any asset. We know asset value methods at book values because that's exactly what we do in accounting. But of course, the value that we attribute to each individual asset can be valued differently, not only at book values, but also at liquidation values, assuming that we liquidate the company immediately and sell all the assets. The assumed sale price, the liquidation price of these assets, will lead to the liquidation value of the company. Or we see the reproduction values, which means we assume that the company is rebuilt newly, so the purchase prices of all assets are used for the valuation. Why do we calculate liquidation and reproduction values? The liquidation value can be understood as the lower boundary of any business valuation. Normally, business valuations are based on the going concern principle, which means that the company does not stop to live or does not stop to exist. Nevertheless, the liquidation of a company that doesn't perform well is always an option. So the liquidation value is the lower boundary of any valuation. The reproduction value might be interesting in a buy or make decision if we decide to buy another company or if we decide to make it on our own. The second valuation techniques are the multiples. I already made another video about multiple valuation. Normally multiples are derived at market prices. So we are looking for peer group companies, look at their market value, and we put it relative to, let's say, the earnings, let's say the revenue, let's say whatsoever, the book value. So we find market multiples based on market prices. We have to differentiate further the equity multiples that are meant to value the equity, and of course the entity multiples that are meant to value the enterprise value or entity value. The entity value are the assets and the working capital, or alternatively spoken, the capital employed. So all the investments in the company, like equity plus debt. We have to differentiate further the recent acquisition multiples. The recent acquisition multiples are not derived by, let's say, exchange prices or stock prices, but the values are derived from recent acquisitions. There are huge databases available where you can find recent acquisitions to derive a price. The present value based methods are based, of course, on discounting, on present values. So the mother of all those models is the dividend discount model. The dividend is the stream of cash flows that flows to the shareholders. So it is more or less natural to discount the dividends. Nevertheless, it is hard to forecast the dividends up to infinity because the dividends can be determined by the dividend policy of the company. To do this forecasting, the continental European countries decided to forecast earnings or profits. Accordingly, we see the capitalized earnings method here. The Anglo-American countries decided to forecast cash flows, which leads to the discounted cash flow method. In the late 70s, the discounted cash flow methods were adjusted for the Modigliani-Miller theory. Modigliani-Miller, we go into that later on, made a theory about the financing of every company. And so within the DCF models, we see the flow to equity method, which is an equity method, and the three entity methods again, the adjusted present value, the free cash flow, and the total cash flow method. Last but not least, there's the real option methods. Real options are based on option pricing formula. Option pricing can only be applied in very simplistic valuations like oil, mining rights, or something similar. They are not very handy if it comes to business valuations. Everyone knows how to calculate a present value, and I already made a lot of videos about that. Nevertheless, due to the high complexity of calculating present values in business valuation, the rollback method was proposed at the beginning of this century to simplify all those steps that have to be performed. Rolling back is pretty simple. Of course, since we have the going concern assumption, we assume that the company does not stop existing. That would lead to an infinite stream of cash flows. And since we cannot simply discount an infinite stream of cash flows, we have to cut it into parts, into the detail planning period and into the perpetuity. The perpetuity will be assessed only roughly applying the Gordon-Grove model or a simple perpetuity model to discount the cash flows. If we then apply those simplistic models to get the present value as of period T, T is the last period of the detailed planning period, we can then roll back through the time or roll back through the detailed planning period. What means that the present value here will be added to the cash flow in T, and then it will be discounted and we will receive the present value as of 4, again adding it with the free cash flow, discounting again, and so on and so forth until we end up in the present period and we get our present value. With their 1963 theory about the financing of company, Modigliani-Miller made some groundbreaking assumptions or built a groundbreaking theory. Let us see what this is all about. Modigliani-Miller assumed that the cost of equity, so the discount rate that we need for discounting, the cost of equity of a levered firm can be given by the cost of equity of an unlevered firm plus, in brackets, the cost of equity of the unlevered firm minus the cost of debt times the leverage ratio times 1 minus tau, which means 1 minus the tax rate. The leverage ratio here is meant in terms of market values, so the non-current liabilities or the debt over the value of the equity, the market value of equity. This is typical in business valuations, that the accounting figures are replaced by market figures, because if you buy a share now, you have to pay the market price and not the book value, of course. Due to this formula, we see that with leverage on the x-axis, the cost of equity of the levered firm is increasing. The cost of equity of the unlevered firm, of course, is this particular spot here. With leverage, the weighted average cost of capital, the WACC, is going down, is decreasing. And it is coming closer and closer to the cost of debt. And this is due to the fact that interest is tax deductible, and the more debt you use, the more interest you can deduct from your tax, and this leads to a decreasing cost of capital here. If we apply this theory in the DCF methods, again we have to differentiate between the entity method and the equity method. Within the entity method, we see three: the APV, the adjusted present value method, the free cash flow method, that is also called WACC method, the TCF method, total cash flow method, that has rather a theoretical background and has not yet arrived in practice, and the flow to equity method, that is very close to the capitalized earning method in continental Europe. The APV method was the first that was derived from Modigliani-Miller theory, and it is based on the free cash flows of an unlevered firm. So assumingly the company must be unlevered, and a cash flow calculation has to be performed that leads to a free cash flow of an unlevered firm. Then the tax shield must be considered, since the tax shield here leads to an increasing value of the company with leverage. So there is a second term only for the tax shield, and there's a third term for the debt. So, discounting the free cash flow, applying the cost of equity of the unlevered firm will lead to the value of the unlevered firm. Additionally, the advantages of the tax shield will be added, and of course the debt will be deducted. That's APV method. The free cash flow method is also based on the same definition of cash flows, the free cash flow of the unlevered firm. Nevertheless, we see only two terms in the formula, because the tax shield is considered in the discount rate, because the discount rate applied here is the WACC. And the WACC, of course, is depending on the leverage and inherits the tax shield. The total cash flow method is based on total cash flows. Total cash flows are adjusted for the tax shield, so the tax shield is considered in the cash flow. While the WACC is also adjusted, the WACC is applied without 1 minus tau, so without the tax shield. The DCF method is rather of a theoretical nature and is not applied in practice. Nevertheless, of course, it can be used. And there's the equity method that is based on the flow to equity. The flow to equity is the cash generated and distributable to shareholders. The tax shield, of course, is inherited in the cash flow, and the discount rate thus is the cost of equity of the levered firm. So this line depending on the leverage. The rollback method, of course, is applied because the leverage of the company changes from period to period, and it has to be adjusted from period to period. A further problem is that we might apply period individual discount rates, and accordingly this is also a big pro to apply rollback methods in valuation. For our valuation that we are going to perform later on, we need some assumptions. We assume that the asset beta is known. The asset beta is the beta of the unlevered company. This is quite realistic because if we derive the beta from a peer group, the peer group betas, the equity betas there, are determined and they have to be unlevered, and then an arithmetic mean can be taken. Accordingly, you will have a peer group asset beta because all the betas have to be relevered. The beta here is assumed to be 0.8. The cost of debt equals the risk-free rate. That is important because we are still in a Modigliani-Miller world. If we don't make this assumption, we end up in the trade-off theory of Krauss-Litzenberger. That would lead to, I just go back that slide, that would lead to the WACC going up again. But since we can't reflect that and since we can't calculate the cost of debt then, it is not implemented in this method. It is assumed to be 8% here. The long average market return is also known. It is 10.5%. There are studies available to calculate this. And with these three numbers, we can go into the security market line of the capital asset pricing model, and we will get something like an expected return of that company, or in other words, the cost of equity, and since it is an unlevered beta, the cost of equity of an unlevered company. And that would be given by the cost of debt plus, in brackets, the market return minus the cost of debt. So in these brackets we see the market risk premium times the beta of the individual company. Or with numbers, 8% plus 10.5 minus 8 times 0.8%, and that is 10%. Further, we assume that the financing structure is autonomous. We assume that only corporate taxes are considered, not personal taxes of the shareholders. Personal taxes of the shareholders can be considered applying a tax CAPM. Nevertheless, let's go the easy way and let's exclude personal taxes from our calculation. The corporate tax system is simple, with taxable profits being taxed at the corporate tax rate tau. I apply tau here because otherwise it would be the same as t, which I need for the time, of course. Since we apply the rollback method, we have to start with the perpetuity formula. And the perpetuity formula of the flow to equity model is pretty simple. It's the flow to equity as of capital letter T plus 1. That means 1 year after the end of the planning, of the detailed planning period, divided by the cost of equity of the levered firm as of t. Okay, the problem here is that the cost of equity of the levered firm is unknown. We have an asset beta, we have the cost of equity of an unlevered firm, but we do not have the levered firm. And we do not have the numbers to calculate it because for the leverage we already need to have the value of the levered firm, and we don't have it. So we are running in a circular problem here. For the detailed planning period, we add to the value in small cap t plus 1 plus the flow to equity of this period divided by 1 plus the cost of equity. 1 plus because we only roll back for one period. But again, the cost of equity of the levered firm is unknown, and again we have a circularity or circular reference problem. If we want to solve the circular reference problem, we need to apply the Modigliani-Miller formula. That is quite nice because it also adjusts the leverage of our cost of capital. So this is what we have from Modigliani-Miller. This is the Modigliani-Miller theory, and we simply input it into the basic rollback formula, in this case for the perpetuity. So we get this formula. And after rearranging this formula, we end up in this formula. Please try this at home. Try to rearrange this formula to get this formula. It is quite easy, so please have a try. We do the same steps for the detailed planning period. So we take the basic rollback formula, we input the Modigliani-Miller formula down in there, and we get this formula. Again, please try this at home. I now switch to Microsoft Excel and show you how that could be implemented. I have arrived in Microsoft Excel, and I did a very simple planning here. This planning example is from the book of Ballwieser, but it's only the planning. The rest of the calculation were done by myself. I have all the other methods that I have shown in other videos. And of course, what is very important, the cost of equity of the unlevered firm is given in the upper left corner. And I gave the cost of equity of the unlevered firm a variable name, COEU. The same is true for the cost of debt, 8%, COD. And the same is true for tau, for the tax rate. Since I don't have any tau in Excel, it is TAXR, TAXR. Of course, I copied that onto my FTE sheet, and I start with the planning of the balance sheet. So I have a planning of a balance sheet here. Of course, it is made of non-current assets and current assets. I have to point out to the fact that the cash is included here into the non-current assets. It is not shown explicitly. Implicitly, this means that a cash balance going up is implicitly an investment into the cash balance, and that will be reflected as an investment in the cash flow calculation. That is important to know, otherwise it wouldn't work. Of course, we also plan the equity and liability side given here with equity, with non-current liabilities, and with current liabilities. I check that total assets equals total equity, having those checks. Seemingly they are all true, or wahr, which is German for true. Then I have an income statement starting with the revenue minus cost of goods sold leads to the EBITDA, minus depreciation leads to the EBIT, minus the interest, and this is important, the interest of 8% cost of debt is levered on the non-current liabilities of the period before, so of the period T minus 1. That is important here, otherwise it wouldn't work. Then we come to the earnings before tax, and I have made an explicit calculation of the German tax, Gewerbesteuer and Körperschaftssteuer. Nevertheless, you can also apply the mixed tax rate of 26.325%. That is usually done here. So after tax we have the profit, and I also took in those two lines, but they are not important. Retained earnings and dividends, they're only important for planning reasons, but not for the valuation. The first thing that I always do is to calculate the tax shield, because we needed to adjust the cash flow calculation. And then I start with the cash flow calculation. The cash flow calculation is, until this line, exactly the same that we know from accounting. So we have a cash flow from operations and we have a cash flow from investment. Both together, of course, will give the free cash flow of accounting. But the free cash flow of accounting is a free cash flow of a levered firm. So we have to adjust it normally, add the interest and deduct the tax to get a free cash flow of an unlevered company. And we add the tax shield again to receive the total cash flow from the total cash flow method. We deduct the interest again, and we add the change of the non-current liabilities, and we end up with the flow to equity. So the flow to equity is the cash flow that is generated and is distributable to the shareholders. If it will be distributed, that's another question here, but it is theoretically distributable. If we now want to apply the rollback method of the flow to equity method, we start with the perpetuity here. And this is the perpetuity formula that was derived in the PowerPoint slices applied to 121, which is the flow to equity. That will give an equity value of 1004 in period 4, and adding both together and applying rollback, I just can show that these two are taken. Applying the rollback formula for the detailed planning period will discount both for one period, and applying the same formula several times will lead to the equity value as of the current year. Thank you for listening, and see you in the next video.